All right, what's up, everyone? I'm back again, and I'm gonna do a beginner guide on how to invest in stocks. So, before I get into this information, I'm not your financial advisor. I'm not your stock guru. I'm just some random guy on YouTube. So, this is for entertainment purposes, and this is a how to invest in stock, a beginner guide, if for getting started. And some of the key points is whenever you're gonna watch this video, before you start investing, you need to determine the best way to invest. To best way to invest in stocks market and how much money you want to invest in. That's the key takeaway from this. So the first thing you need to do is determine the stock investment strategies. There's a few stock investment strategies. You ask and determining the stock investment strategy involving, there's several key steps. There is something called dividend investing. There's something called um, blue chip investing, and you just have to determine the style investment you want. So before you choose your stock, think about assessing your financial situation and goals, because not everyone is in the same financial situation. This is why I can't really help you besides tell you, some information. So if you understand your risk tolerance and your investment goal, it's the first thing you need to do. And then two is choose an investment approach. So you can choose individual stock, index funds, or let it automatic invest for you, or robo advisor. Now, if you're not going to actively look at your stocks portfolio, I do not advise you to do stocks. I advise you to do index funds, because index funds are managed for you. Now, robo advisor, I don't really like doing, because it's an automated platform that creates and manages your portfolio based off what your risk tolerance, and it's not always the best. But you need to find your investment strategy. Now, there's some key investment strategies like value investing, where it's focused on undervalued stocks that have strong fundamental. There's growth investing, which is what I kind of do. Target companies with high growth potential. There's dollar cost averaging, where you invest a fixed amount of regular, regardless the market condition. And momentum investing. Buy stocks that trends upward and sell them when they start declining. And this is more of a day trader. Now, number four of this is you need to diversify your portfolio so you can spread out your risk in your investment. Now, staying informed and reviewing your stock regularly. Now, more into individual stock. You can invest in individual stocks if and really only if you are desire to do research and evaluate your stocks on an ongoing basis. If this is not the case, I don't encourage you to do individual stocks, because you invest in a company, it's not like trading. Now, the difference between trading and investing is, one, it's more like gambling, and that's like day trading, because day trading, monthly trading is where you buy a stock on the low and you sell it high. And I am talking about investing in stocks. So the next thing you need to do is decide how much you want to invest in your stocks or your investments. So decide how much you want to invest in stocks. It can be really tricky, and you should talk to a financial advisor. But if you don't want to talk about financial advisor, I recommend you first have your emergency fund, and you should first, before you start trying to invest. So whenever you are seeing that you are financially secured enough to invest, no, then you need to set clear goals to what you want to do. So, what I mean is clear goal is determine what you want to achieve with your investment. So, if you want a 10 or 15% return, you need to look for that 10 or 15% return in that stock. You're not looking at the stock market the same as someone who's trying to day trade, someone who's trading. You are looking at a certain rule set that you put for yourself and not for anyone else. Now, now you can sit there and look at the market and do average of 10 years, 5 years, and 1 year, and I'll show you that and determine, hey, this in the last 1 year, 5 year, 10 year, and then you average on what you expect the return to be. And you just have to follow a certain rule set whenever you invest. So you have to set very clear goals. Now, determining your risk on your investment, because this is a investment, not a trading, or and it's not for you to constantly sit there and say, hey, I'm gonna sell whenever something bad happens. This is for investment purpose. So you have to treat this as a stock investment and not a day trading. Now, I recommend you follow a simple rule of 10 or 20% of your income going into your investment. And this is where you have to determine what you want to do. And the next step to that is you start small and you and increase gradually. So you start with 500 bucks, $100 a month, and then you gradually increase it where you can comfortably live and comfortably invest at the same time without dipping into your living situation. You find out you are able to really invest more. Now, six is diversify your investment. And what I mean by diversify your investment, you don't want to be in one sector too much. Well, if you're in oil and gas and you have 90% of your stock in oil and gas, it's not really diversifying your portfolio. It's not really mitigating any risk, because usually if oil takes a hit, all the oil companies takes that hit. If the communication sector takes a hit or transport sector take a hit, they generally all take a hit. So you want to diversify it, and that will help you. And then lastly, on whenever you are investing in stocks, is you need to regularly review your and adjust. Even if you have index funds, you want to, or mutual funds, you really want to look at it regulatory, because it's very important to look at your stocks regulatory. After you look at all your research and studies on your investment, then you're going to have to start looking into, hey, what investment account should I open and where should I open it at? Now, I invest with Fidelity. It's not a sponsorship or anything like that, but I use Fidelity because they're in the top institutes for finance and investment. And they also give me a few insurance on the investments, which mean they give me FDIC secure and SPIC secured, which is insurance that covers my investment and my money in the portfolio. Now, you can open up an investment account and it's pretty easy. You just determine your investment goal, choose the type of account you want, because not just you have to look at your account. There's plenty of investment accounts. There's a standard brokerage account that I use for my dividend portfolio, and this is one that does not provide tax advantage because it's not a tax advantage account. There's a margin account which allows you to borrow money to buy secure, which I don't recommend using. And then there's typical retirement account, where it's traditional IRA, Roth IRA, 401k, Roth 401k, SEP IRA, SEP, Simple IRA. Now, I recommend if you're opening a investment account, you first use a Roth IRA because you get to invest your money tax free um, for the earnings, and that's the best thing. You know, if not, try to max your traditional IRA and then go into a brokerage account. The max you can put a year 6,500 unless you're over a certain age, and then there's educational accounts and HSA accounts. Now you have to choose. I'm not gonna go over all of them. There's plenty of them to choose from, but I recommend using a Roth IRA and your traditional IRA, and then a standard brokerage account. You're gonna have to look up more which one you want to do, but in hindsight, Roth IRA you contribution are made after tax dollars, so you pay taxes now but don't pay taxes later. And traditional IRA is tax deductible now, which you don't pay taxes now, but you will pay taxes later. That is the two key differences, and based on your investment and your strategy, you need to incorporate that into your investment. Now, after you choose your account, you need to compare the fees and services because not all brokerages are the same. Some charge more fees than others, and that will make a difference on your futures earning. And then you just complete your application, and you pretty much good to go. Learn the app and start investing. Now, you're gonna choose your stocks next after you open your account. So if you're gonna choose your if you're gonna choose your stocks, you're gonna have to look at your stock portfolio and what you want to do. But choosing a stock is not that hard. I recommend if you choose a stock, you know something about the stock. So you need to do your research and due diligence. Now, I have pretty much a guideline that I follow. I don't invest in any stock that doesn't give a average return in the 1 year, 5 year, and 10 year. The 1 year, it needs at least a 5% return a year. On the 5 year, it needs at least a 10% return or 7% return to match the S&P. And then the 10 year, it has to match the S&P or do better than the S&P. That's my guideline for me. So if the growth isn't better than the S&P, why don't I just pick the S&P? That's what I assume. So my guideline is the S&P 500. So those are my guidelines. I my 1, 5, and 10, I do look at the average and compare them to the S&P and see if they done better or worse. If they don't do better, I kind of not buy them. The second thing for my investment portfolio is it has to pay dividends. Now, I want to make sure my dividend stocks or my investment portfolio they pay dividends. So, a dividend stock is a company that rewards its stockholder for having the stock. I figure, hey, if I have a stock and I'm an investor, I at least want a passive income from them because I want to be paid to own that stock. That's my assumption, and it's a passive income. Now, there's levels to dividend stocks. There's dividend kings, and those are companies that have increased their dividend for at least 50 years. There's dividend aristocrats, and those are companies that increase their dividends for at least 25 years. There's a dividend achievers, and those are 10 years. There's high dividend stocks. Those are dividend that do high dividend yield. And there's growth dividend stock companies that's not only paying dividend, but also have potential significant capital appreciation. So I look for growth dividend stocks. It's very hard to find, and there are not many I can add to my portfolio. So I'm very strict on my requirements. Now, is it okay for you to be strict on where you invest your money? Yes, it is your money. And if you're doing your research and due diligence, you want to put your rules and guidelines as if you are buying a company. Because essentially, if you're buying a stock, you are buying a piece of ownership of that company. And that's how I treat my investment. This isn't a day trading event. Now, if you have all your goals and everything set, now you need to define your investment goal. What is your overall goal? Relook at everything. Say, okay, I analyze my stocks, I understand my risk tolerance, and now I want to really invest. So the reason why you want to always invest is because of the rule of 72. And this is telling me, hey, if I invest my money and I constantly invest my money, how am I going to, how fast is my money going to grow? Well, the rule of 72 is simple. You simply divide 72 by your annual interest rate. For example, your investment earning of 6%, it would approximate 12 years to double your money. So if you have a 12% growth in your portfolio, that means it will double every 6 years. If the math works out correctly. I didn't do the math, but that's the double rule of 72. So I at least expect my portfolio to double every 12 years. Now, the benefit of it is it's accelerating growth. This is compounding interest. Now I'm going to show you an example of a stock. Now, this is AT&T. It's a dividend paying stock. It pays 1.1% or $1.11 of dividend, and it has a 5.70%. This is considered a high dividend. Now, I always look at the 1 year mark, okay, and see how well it does. In the 1 year mark, it grew 34%, check. And then you can always add the S&P to these lines if you want to compare to other places. Now, the 3 year mark, I also look at. And right now, the S&P has a negative 8 point, not the S&P, AT&T has a negative 8.26. Now, I look at the max and see how it's done. Well, it looks like to me, based off this, it's not a bad stock to have. But this doesn't meet all my criteria. I also look at the insider trading and see what the corporation is doing and what investors are in here. But those are my requirements, is what I look at. Now, the reason why I look at who's investing in it, because these big financial institution owns large part of these company, and they can make these stocks skyrocket or drop if they sell all their stocks or they buy a bunch more stocks. And the other reason why I look at the insider trading is because, hey, if something happens, and these people on the inside will know better, and why are they selling their stocks? That's just my personal opinion. Now, you don't have to go into the finance if you don't want to, but I always go into finance, and I always make sure they're in the profit, because if I see that they're in a negative, it doesn't make sense for me to invest in a company that does not make money, because that means they can't pay their dividends. Now, I'll also check the news about it to see that they have positive news more than negative news, because that does affect the stock prices. So hopefully this helps you out. Those are just my common tips and tricks how I look at stocks in the beginner guide. You can go more in depth, look at the projection, guess what it's going to be. You can do the 1 year, 3 year, 5 year, 10 year, 20 years, whatever you want to do. This is just for a beginner's guide. This is how I look at it. I compare my 1, 3, 5 year to the S&P, and if it does better than the S&P, then I'll look into purchasing them, and then I'll look at everything else. Please like and subscribe to my video, and stay tuned for more.